All right, so up to this point, we've been learning about the accounting cycle. The one on the slides slightly different than the one I drew on the board in that they make a separate step for analyzing transactions and then journal entries, whereas I just said, to me, like making the journal entry is analyzing what's happening and then putting it in the journal entry. And then posting it to the ledger, then preparing the unadjusted trial balance, then preparing the adjusting entries, and then I didn't make this, so blame it on the textbook publisher. Preparing adjusted trial balance. And so that's kind of where we are, right? We just, chapter 3, we covered adjusting entries. I told you they were going to be hard because mostly just because the language in them, like it's hard sometimes to know what they're looking for. Sometimes like the actual adjustment's not hard. It's like, oh wait, are they telling me the amount to do for the adjustment, or are they telling me how much I have left over? So I have to figure out how much I have to do for the adjustment, right? That's the hard part about chapter 3. So chapter 4, and we did look at preparing financial statements a little bit in chapter 3 too. Chapter 4, then we get into the closing process. Closing sounds like a big thing, but all it is it's returning the balances of our temporary accounts to zero so we can start a new month. And so the temporary accounts are the income statement accounts and the dividends. Okay. So we're going to figure out in this chapter how to take our revenues back down to zero so we can start a new financial period, our expenses down to zero, and our dividends down to zero, and what we do with that money. The hint, you already know, we move it to retained earnings. You've kind of seen that pattern, but not explicitly, that our revenue and expenses, those become net income, and that gets added to retained earnings, and the dividends get deducted from retained earnings. We've seen it already, but that's what this chapter is going to cover, that process. So we're just going to jump right into a couple problems on the guided. So the part 1 for chapter 4. Let's see. I'll bring this over here. Capítulo 4. Parte número 1. All right. So this first question is just trying to figure out, I guess, something. This is like review almost of things we've learned already. So this is the balances for the accounts that follow appear in the adjusted trial balance columns at the end of period spreadsheet. Indicate whether each account would flow into the income statement, statement of stockholders' equity, or the balance sheet. All right. So accounts payable, what kind of account is that? Liability. And so where does that end up going? Nope. Balance sheet. Good guess though. Accounts receivable, kind of account is it? Asset. And where does assets go? Balance sheet. Cash is an asset. Where do assets go? Balance sheet. Dividends, they're weird. They're their own kind of thing. They really only go to statement of stockholders' equity, right? They don't show up on an income statement because they're not expenses, even though they feel kind of like expenses, but they're not, right? Because an expense is something we use to earn revenue, but a dividend is just paying out to the owners. And so it's not part of the operating of the business really at all. It's just part of sharing those profits with the owners. So that has to do with stockholders' equity. Fees earned, what kind of account is that? Revenue, good. And revenues and expenses both go on the income statement. Supplies is an asset, so balance sheet. Unearned rent. That one's a little weird. When it says unearned in its name, it's a liability. It means you owe it. It means somebody's paid you in advance and you owe them the use of the building, or that's what that, in this case for rent. And so liabilities always go on the balance sheet. Remember, balance sheet is assets, liabilities, and then equity, and then income statement is revenue and expenses. But then the equity comes from, in the end, we'll see how it comes from the revenue and the expenses. That gives us our net income, and we'll take the net income and put that over to retained earnings. So right now, at the end of the month, we're going to put any revenue on the income statement, any expenses on the income statement, any assets or liabilities on the balance sheet. And then the stockholders' equity is a little weird. We have to figure out how it's changed. Okay. So here, these last three are all expenses. So they're all going to be income statement. They're not. I got tricked because I was not paying attention. So wages payable, what is that? It's a liability. So where does it belong? Balance sheet. Sorry about that. I led you astray. I have a poor shepherd who led my flock astray. All right. You guys didn't know you were my flock, huh? Yes, I'm making some sort of strange biblical reference to our relationship as an accountant class. It's kind of weird. All right. Didn't mean to do that. All right. So now we have balances for each of the following accounts appear in an adjusted trial balance. Identify each as an asset, liability, revenue, or expense. So again, pretty simple. This is like review stuff for us. Accounts receivable, asset, right? That's money we've received, or I'm sorry, money we've earned but have not yet received. So it's money owed to us. Equipment, asset, fees earned, revenue, insurance expense, prepaid advertising, asset. Anytime it says prepaid, that's an asset, right? It means we've paid in advance for advertising, so someone else owes us advertising. So prepaid rent, same deal. It's an asset. Rent revenue. It's a revenue. The only one that tricks you out that is unearned revenue because it has revenue in its name. You're like, oh no, that's a liability. That's weird. Salary expense is an expense. Salary payable, liability. And usually that only exists in those situations where we've done an adjusting entry at the end of the month to recognize that our employees have earned salary, but we haven't yet paid them, right? Or in other words, we've incurred the salary expense, but we haven't paid them. So we debit salary expense, credit salary payable, and then as soon as the next paycheck comes, we pay off that payable. Supplies, asset, supplies expense, unearned rent, liability. Again, that's somebody had paid us in advance. Like I said, when I owned my storage business, it was really common for people, instead of paying monthly, to just pay me for a whole year in advance or for 6 months. And so I had to record that as unearned rent. And then each month I do an adjusting entry to show I'd earned part of it. I could put rent revenue and then would debit the unearned rent so that that liability was dropping off over time. Okay, so those two weren't too bad. So let's get back to, whoops. We could get down to business to defeat the Huns, right? What a sexist song. Donny Osmond, I expected better of you. Do you know that Donny Osmond was that voice in Mulan? Dude can sing, even if you don't like him. He was also Joseph in the Amazing Technicolor Dreamcoat, which was a weird play by Andrew Lloyd Webber. All right. All right. So we know our financial statements. We've seen them before. Here they are again. We have revenues, expenses, and then revenue minus expense is net income, right? We've learned that already. So that's the income statement. So one thing to look at is on the title of the income statement, it will always say this one's a 2-month income statement, which is weird. Usually in real life, you see 1 month or a quarter, which is 3 months, or a year. So for whatever reason, they're doing 2-month ones. I don't know. Because you know what I think you should do whenever you're dealing with brand new students who are just learning about a concept, you should throw them like a curveball that nobody sees in real life. That's what I think you should do. All right. Way to go, Cengage. All right. Give people like standard normal things you would normally see at first. Right? Right. All right. So we can see that NetSolutions has two different revenue streams. One is the fees earned. That's the business they do. And the other is rent revenue. So they're renting something to people. And then their expenses, wages, supplies expense, rent expense, utilities expense, insurance expense, depreciation expense, and miscellaneous expense. Anybody remember what depreciation expense is? Yeah, the cost of when you buy a long-term fixed asset, like say a piece of equipment that's going to last for 5 years, you want to spread the cost of that out as an expense over the 5 years. And so you depreciate or recognize a portion of the cost of that each period in time. So we can learn a lot about a business just by looking at their income statement, right? We can see how they earn revenue. Fees earned would tell us that this business does uh, services for people rather than selling them stuff like a Walmart. Walmart would probably have sales revenue or something like that as their revenue or sales. And then we could see that their biggest expense is wages. Second biggest is supplies. Third is rent. And fourth is utilities. And then the other ones are quite a bit smaller, like relative to that. So we learned something about the nature of this business. So before I was a teacher here, I used to run the Small Business Development Center here on campus. And what I would do is work with businesses and help them understand their financial statements. That's not the only thing I would do, but it was an important part because a lot of business owners get into business because they're interested in what the business does. They make knives or they like having a restaurant and they don't they're not experts in financial statements. They don't even care really, except that they have to because if they don't make a profit, they go out of business, right? All right. Then we have their statement of stockholders' equity. We can see that they had zero common stock, zero retained earnings on November 1st. Then they issued common stock of 25,000. That tells us the owners injected $25,000 of cash into the business. Very normal when a business starts for the owners to put money in. That's how the business starts operating, right? We also can see that the business had net income over this period of $7,105, which means their revenue exceeded their expenses by $7,105, and that the owners took $4,000 of those profits back out as a dividend for themselves. So at the end of the period, we have 25,000 in common stock, 3,105 in retained earnings. Add that all up, we have 28,105 in total stockholders' equity. Another way of thinking about what stockholders' equity is say, so that's the amount of the business that belongs to the owners as opposed to belonging to a lender or somebody like that, somebody you borrowed money from. So you can say the owner's stake in the business is now 28,105. The amount they put in was 25,000. So the additional 3,105 came from what the business earned by operating. Okay. So that's a good thing to know. If you're going to invest in a business, like how much of its equity has actually come from, because some businesses will have like no earnings or negative earnings for several years. Think of like a big tech company like Microsoft when it first started. That was mostly just the owner trying to like keep the business alive until the rest of the world could catch the vision of what he was doing, right? In 1975, the CEO of IBM said he foresaw a day when maybe the world market for computers would be 1 or 2,000 computers worldwide. Like someday it would be that big. And Bill Gates and Microsoft and a few others said, we think everybody could have a computer. But even then, their vision was limited. They were thinking of like a personal computer in their home. And now we all carry computers in our pockets that have way more processing power than my first computer, which was an Apple IIc, had no internal memory. We had to store everything on the floppy disks, right? And now this has, what does this have? this has a terabyte of memory. So you're like, that's ridiculous, right? And the processing power of it too is insane. Um, so we can all look at video all the time, and it's always really instructive, important video, right? People wouldn't waste this technology just to post stupid jokes about stuff. That'd be silly, right? Do that anytime you're like looking at TikToks or something, just or like whatever, just think we had all of this power and this is what we used it for, right? Like that's what I tend to think of sometimes. All right. All right. And then here's our balance sheet. Remember, it summarizes assets, liabilities, and stockholders' equity. So we can see that there's all their assets, and this shows us something called uh, a multi-step or type of balance sheet, which has broken the assets into two types: current assets, which we'll learn more about in the future. But current assets, in essence, means assets that that are either cash right now, so cash is included, or that we expect to be turned into cash in the near term, usually a year or less. So things like accounts receivable, we expect to collect on those assets within a year, I hope, usually within 30 to 60 days, right? Supplies, those we don't expect to convert to cash, but we expect to use up. And then prepaid insurance, most prepaids are current because we expect to use that insurance. So maybe I should restate and say current assets are assets that are either cash, we expect to convert to cash, or we expect to consume or use up all within the next year. Okay. And then that's separated from property, plant, and equipment, which is assets that we expect to last longer than a year. So land, equipment, and that's all they have. And you can see their office equipment. It gives us the cost minus the accumulated depreciation, which gives us the book value. So this business has $29,495 in assets. It's got $1,390 in liabilities. And then the difference is the 28,105 in stockholders' equity, of which we learned in the previous statement, 25,000 came from owner contribution and 3,105 came from retained earnings. Again, retained earnings really is what its name says. It's earnings of the business, profits that we have retained and not paid out. So it's the net income minus the dividends. So again, you guys already know these statements. We've seen them before, but I guess this chapter is meant to sort of wrap up the accounting cycle and say, okay, after we do the adjusting entries, we make our financial statements, and then we're ready to do our closing entries, which we'll actually do tomorrow. So today we have one more question. Somewhere on here. All right. So Demo Consulting is a consulting firm owned by and operated by Jesse Flatt. Following end of period spreadsheet was prepared for the year ended August 31st. During the year ended August 31st, $15,000 of additional common stock was issued. All right. So we haven't seen it in this format before, but sometimes you'll see this is called a worksheet, but it has all the same information. It has the unadjusted trial balance. And over here is all the accounts, and they're in that same trial balance order: assets, then liabilities, then stockholders' equity, then dividends, then revenues, then expenses. Okay. And then it does the unadjusted trial balance, any adjustments they made at the end of the month, and then it gives you the adjusted trial balance. So it tells us, based on the preceding spreadsheet, prepare an income statement for Demo Consulting. So really what we're interested in here is the adjusted trial balance. That's what we use to create our financial statements. I think all the rest of this is given to us to show the process and maybe to obfuscate so that we're confused, like, oh, which do I use? But we know that we use the adjusted trial balance, okay? So to make an income statement, and again, you'll notice income statements will say for the year ended August 31st. That means the income statement covers a time period. For balance sheets and for statement of stockholders' equity, I'm sorry, for balance sheets, you'll see just a date. Because now we're not saying this balance sheet covers this last year. We're saying these are the balances as of this date. Okay, so there's a difference. All right, so let's do our income statement. It's going to have our revenue account, which was fees earned, and our expenses, which are all right here: salary expense, supplies expense, depreciation expense, and miscellaneous expense. Salary expense, supplies expense, depreciation expense, and miscellaneous expense. And then we'll just take the values straight off of the adjusted trial balance. So fees earned, 1 million. Good job, buddy. 480,000. Salary expense, supplies expense, depreciation expense, and miscellaneous expense. I'm not going to try to add all those in my head. So I'll just add them up. 843, 100 plus 22. So I get total expenses of 890,000. Okay, so if my revenues are greater than my expenses, will I have a net income or a net loss? Net income, right? If my expenses were greater than my revenues, then I'd have a net loss. And that does happen in some years for some businesses. And our net income is just our revenue minus our expense, right? $590,000 in net income. That seems like a pretty good year to me. I'd be taking a big fat dividend off of that. Maybe driving a new Corvette or something. I don't think I would fit in a Corvette. Any car that's too low now. I hate getting into cars that are too low. I also hate, my son has this truck. My son, he's on a mission, so it's like just left here for us to use, but it's like super lifted, like he's compensating for something, kind of. It's that lifted. And so I don't like climbing into that thing either. Just give me a normal car that can just sit straight across, well, or a regular truck that can just sit straight across. What's that? Well, right now I'm driving my son's, well, I'm driving we have an old Ford, like a Ford F-250. It's like it's old, it's like a 93. So that one I can just sit right into, stand right out of. I like that truck, except it doesn't have AC. So I don't like that part of it. Hey, the thing was made like the year after I graduated high school. The fact that it's still going is pretty good. It looks like it only has like 100,000 miles because it only had the thing only goes to 100,000. So it like just rolls over. So I don't know what it actually has. All right. So there's our income statement. So now we're ready to do our statement of stockholders' equity. Remember, these always begin with the balances at the beginning. So September 1st, 2018, I guess, 20Y8. I hate that it does that, but it's, I guess, so that they can leave the problems the same, no matter what year it is. All right, so their common stock. So this one told us up here that they issued $15,000 of common stock during the year. So this common stock amount that we have here is the ending common stock. So we know then that the common stock balance at the beginning was 85,000, and somewhere during the year, right, it became 100,000. So even though it says 100,000 on our trial balance, because it tells us 15,000 was issued during the year, we're going to say it started the year with 85,000, that we issued 15,000, and now there's $100,000 in common stock. At the end of the statement of stockholders' equity, that always ends with the balances at the end of the period. Or so it's saying balance at the beginning plus any common stock issued plus net income minus dividends will give us our new stockholders' equity. Does that make sense to everybody? Why I did 85,000 and 15,000? Yes. Okay. All right. Then our retained earnings was 810,000. So we're going to have a starting balance up here of 810,000. We know that there was net income. We can go back up to our income statement and see our net income of 590,000. So that's going to add. And then the last thing is the dividends. We can come up here and say, oh, it looks like they paid out $30,000 in dividends during the year. Let's see, let's see. If a net loss is incurred or dividends were paid, enter that amount as a negative. So I'm going to say negative 30,000. The thought being that reduces our retained earnings, right? So our retained earnings started the year with 810,000. We added 590,000 in net income and subtracted 30,000 in dividends. So we now have 1,370,000 in retained earnings. So this isn't a small company, nor is it a giant company, right? $1 million sounds like a lot, but compared to somebody like Walmart or Freeport McMoran, the mining company that we have here in town, pretty small. Now to find our balances, we just add them up. So 810,000 plus 85,000 is 895,000. Common stock issued 15,000. Net income 590,000. We could use a check about now. See if I made any mistakes. It does happen. All right, so what have we learned about this company? We've learned that they do consulting works, which means their fees earned are made not by selling product, but by providing a service. That's what fees earned means. We've learned that the vast majority of their expenses for operating are salaries. Okay, so they're a salary intensive company. Other types of businesses like that, college, something like 75% of our expenses are payroll, paying for our faculty, our staff, the people who keep the campus looking so beautiful, right? All of that kind of stuff. So that's definitely the nature of this company. Then they have supplies, depreciation, miscellaneous. So we don't even see like, doesn't look like they're even paying utilities. They're probably running it out of someone's house, right? Like we can learn a little bit about them just by looking at this. Here we learn that whoever invested the money in the business has made a pretty good return on their investment, so to speak, right? They put 885,000 in, and as of the beginning, it has 810,000 in retained earnings. And at the end, they were able to take 30 grand off of it and still have like 1.37 million in retained earnings. So they're doing all right. I'm guessing, I don't know, but most likely the owner of this business does most of the consulting. And so they also have paid themselves a salary throughout the year, in addition to that 30,000 in dividends. I would give them tax advice that says take more of that as a dividend and less of that as a salary, though. Salary is subject to not only federal and state income taxes, but it's also subject to FICA withholding, which is like Medicare and Social Security withholding, which is like almost like 15 or 16%. So if you take it as a dividend, you don't have to pay Social Security and Medicare. So all you have to do is pay yourself a reasonable and customary salary, and then all the rest you can take as dividends. It'll save you some money, but we'll get into the tax side that much nowadays. But even for like my wife's little mural painting business, we do that where we pay her a wage of $22 an hour, and any other money we make on the business is a dividend to us, right? So, and that saves us, depending on the year, $2,000 to $5,000 a year in taxes, and it's legal, right? So that's my job, is to make sure we pay as little as we have to, but do so legally. I don't want to go to jail. All right. So we've done our income statement, our balance sheet. We've learned a little bit about the business. And now, I'm sorry, we've done our income statement and our statement of stockholders' equity. And now we're going to do our balance sheet. So you can see this balance sheet again is broken down into this more detail-oriented balance sheet that has a separation of current assets. So of all these assets, let's figure out which ones are current, which means either they're cash, or they'll be converted to cash, or they'll be used up in the next year. So that would be cash, definitely. Accounts receivable, yes, and supplies. Those three are short-term or current assets. So I'll get into a lot of scrolling here. Cash, accounts receivable, and supplies. And again, we'll just take those balances straight off of our adjusted trial balance. So the cash is 182.5, 234.5, and 5,000. And then we'll just add those up to get our total current assets. Pause them. I go and just take all that money out of my checking account and just have $182,000 in cash sitting there just to look at it. I wouldn't actually. It's far safer in the bank, right? You could fill up a bathtub with it and sit in it. You can make it into gold coins and swim in it like a Scrooge McDuck. I don't think that would actually work though. Something about relative density. It's more dense than me. All right. Still be dope though. I've always wanted to have like just like a 1 pound little bar of gold just to have it. But right now gold is like 2,000 an ounce. I don't know what it's at right now, but that means it'd be $32,000 to get that one little bar of gold. And a pound of gold only like this big. It's sort of disappointing. Like you always think of those big bricks, like Fort Knox bricks. Those are probably, I don't know what those are, probably a couple kilos. So I probably won't have a 1 pound bar of gold. My uncle was in the hospital earlier this summer and he thought he was going to die. And he's like, "Hey, I need you to come down to the hospital." And I was like, "Okay." And he's like, "I got to tell you where all my gold and guns and stuff are hidden. So in case I die, you can find them." And I'm like, "All right." And then like he started getting better and he was like, "Never mind." I'm like, "All right." It's just like, you have gold and guns hidden at your house. That's cool, I guess. What's that? Well, he never told me. Yeah, he started getting better. This is funny. He's so this guy is like 74, 73, and he's never been married, never had any kids. And so he's like super set in his ways. Like he's never had to live with anybody else ever. Um, and so he's like, he's got all these weird things where he's just like super rigid and like, but he like really loves my mother, who's his only sibling. Um, and so he's just like, you guys aren't getting any of my money, right? It's all going to your mom if I die before her. I'm like, "Oh, that makes sense." But he's just like I don't know, he like assumes everybody's greedy or something. And I'm like, "That's fine. It's your money. Do what you want with it." And my mom's the opposite. She's always like, "I want to make sure there's something left for you guys." And I'm like, "It's your money, mom. Like, that'd be cool if you leave me an inheritance. That'd be super neat. Okay, but like, spend it. Like, But then she'll want to buy something stupid, and I'll be like, don't buy that. Like, let me spend 120,000 on an RV that I'll never use. And you're like, yeah, or you could stay at hotels for a couple $1,000s. All right. But then I'm like, it's your money, but like don't spend it on that. All right. Anyway, it's a funny thing. All right. So those are current assets. Someday everybody's parents get old and then you're like trying to help them out and like they worry about stuff like that. Like, oh, you guys need to inherit some. And you're like, okay, if I haven't got my life figured out financially by the time I'm 60 when you die, like that's kind of on me, right? Like, anyway. So property, plant, and equipment. We'll go up here. We'll look at what we have. We have land, office equipment, and that office equipment has some accumulated depreciation. Land doesn't depreciate, so you can't ever take an expense for land, which is, I don't know why. It's a rule they made a long time ago with the IRS, and that's still the rule. So we're going to do land, and then we're going to do office equipment, accumulated depreciation, and the difference between the cost of the office equipment and the accumulated depreciation is the book value of the office equipment. So land had a balance of 775,000. Office equipment had a balance of 400,000. And the accumulated depreciation account had a balance of 72,000. They want that as a negative. Usually you don't list it as a negative, but you do subtract them. So 400,000 minus 72,000 is going to give us what? 328. It'll be interesting when we do our check if they wanted us to do that as a negative. So our total property, plant, and equipment then is the land plus the book value of the office equipment, which should be what? 1,103,000. The problem with doing it in your head like that is if you make a mistake, it like cascades, it goes through the whole thing, right? So sometimes it's better to double check. 422 plus 1,103 is 1,525,000. Whoops. I got an A already. I could just quit here. Now, I know you guys. I've already watched you. A 98. I'm gonna redo that whole thing. Right? Sometimes it just bugs you. You like can't let it sit. That's why people hate exams because it's like, so I just have to live with that grade, and you're like, "E senor, you have to live with that." Sorry, but life's okay, and there's more tests to come, so you'll do fine. All right, our current liabilities. Again, current liabilities are liabilities that we expect to have to pay off within the next year. Long-term liabilities would be liabilities that are older or longer than a year. In this case, though, we only have current, which so I mean, this company's doing pretty good, right? They have all these assets and they only have a couple of small current liabilities. They don't have any big long-term loans that they owe on. So see where we at here. Accounts payable of 41,500 and salaries payable of 13,500. So they have 55,000 in current liabilities, no long-term liabilities, so total liabilities of 55,000. Finally, the stockholders' equity, which is going to be our common stock and our retained earnings. This gets a little confusing sometimes because we've been going all the way up to the adjusted trial balance to get all of our other information. But for this, we're just going to go up to the statement of stockholders' equity because that's where we figured out what the new balances of those accounts should be. So our common stock account has a balance of 100,000 and our retained earnings has a balance of 1,370,000. So our total stockholders' equity then adds up to 1,470,000. And our total liabilities plus stockholders' equity should be, what is that? 25. So 1,525,000. We can come up here and make sure and say what was our total assets. Oh, well, good. They were 1,525,000. Assets equal liabilities plus equity. So we should be good. We get 100%. We go and give a big hug and a kiss to our significant other. Unless we don't have one, then we sit in sorrow, or something like that. I don't know. Or maybe we celebrate the glad tidings of the fact that we're not, in a relationship right now. One or the other. Anyway, so that's it. So we'll submit it and be glad. And that's it for the first part of this chapter. Tomorrow we'll do those closing entries. And then, you know how you just had an exam? There's another exam covering chapters 1 through 4. And pretty much, if you think about it, it's going to be like, can you do journal entries? Can you create a trial balance? Can you do adjustments? Can you create an adjusted trial balance? Can you use the adjusted trial balance to create financial statements? And then can you close, which we'll learn about tomorrow. So that'll be coming up, I think, next week, that exam. All right. So that's enough for one day. I feel like this class so often provides so much information that like your brain is like, okay, that's enough for today. I don't know why there's so much. This one wasn't too bad compared to some.